Tom Bowley, Chief Market Strategist here at Earnings Beats. Hey, good morning, everybody, and welcome to this Tuesday, August 20th, 2024 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be with you for the next 30 minutes or so as we prepare for yet another market open. Market rally has been impressive, no doubt about it. We've seen a pretty big rally off the bottom back above where we were during the Fed meeting, at least in some key areas of the market. Very difficult to say too many bad things about what the market has done over the last couple of weeks. It's been an impressive rally, and I'll be talking about that quite a bit throughout today's session. I know many of you may question, how can you be bearish and 2 weeks later be bullish or be more bullish or less bearish? But literally the stock market changes every day. We get a lot of new reports. We get new clues. We get new intermarket relationships, the way, everything is working, rotation changes. And so as technicians, we have to change with it. Certainly as we were dropping a couple weeks ago, I was pretty cautious near term, pretty bearish actually in the very near term, but long term, what I continue to say is it's a secular bull market. And many times you will see a secular bull market put its head down and power right through weakness. And that's what we're seeing right here. Unfortunately, when I got bearish, really bearish, was right after the Fed meeting. I didn't like the rotation that was taking place. A lot of things that had changed back on July 11th with the June CPI report when it was released. A lot of those things changed. A lot of the rotation that we had seen that looked so bullish going into the Fed meeting had changed, and we saw rotation again taking place, which was favoring being more defensive. And so that's what we did right after the Fed meeting. That's when I said, hey, I'm going all cash. Told members, do what you feel comfortable with. But I was going cash, I want to just be transparent and open about it. Market took a big hit over those next 2 days. I think the S&P 500 was down about 6 or 7% in 2 days. So I think it was a worthy signal, but obviously a lot of things have changed. And I would say at this point, what I've been telling members is that I think the bottom is in. I think that move down in August, we're not going to go back down below it. I don't believe we will. I do still think we got some obstacles and challenges ahead, as we typically do during presidential election year cycles. I think that there's still maybe some lingering rotation issues, and there's still some question as to what's going to lead the market in the fourth quarter. I'm beginning to think less and less like it's going to be an outrageous move to the upside in technology. But you can't argue with how technology's performed here over the last week or two, especially last week. So my focus is still, very much the same as it's been, believing that we're in a long-term secular bull market. But how this third quarter plays out, I think that's where I'm seeing some changes here over the last couple of weeks with the way the market has evolved. And I know I've received a lot of questions at Earnings Beats, and I can understand why. We had a big drop down, a huge drop, and we've had a huge rally right back, almost a V move right back to the upside. And a lot of things have changed, including volatility, where we saw tremendously high readings showing fear and panic in the streets. And now to a point where the VIX is all the way back down in an area where we continue to generally see secular bull market behavior. So there's a lot that's taken place in the last couple of weeks. I think probably there's a little bit of manipulation, maybe a lot of manipulation going on in terms of Wall Street. Most of those moves to the downside after the Fed meeting were gaps. They were not distribution. It was not heavy selling. That was one of the things I talked about back before the drop, is we wanted to see the nature of the selling. Most of the nature of the selling was gap downs. Since then, you can see, the last week for sure, we've been finishing on the high almost every single day. This is clearly a sign of accumulation. So anyway, with that said, let's take a look at some of the charts and what happened yesterday, and then we'll go through some of what's been happening and talk about where we might go. The Dow Jones Industrial Average yesterday up a little bit more than 0.5%. The S&P 500, let's zero in here so you can get a little bit better look. There was the Dow. gaining 236 points, getting back close to 41,000 and close to the recent all-time highs. Look at the AD line down here. It had obviously been weakening quite a bit. And since this rally started, maybe just a little bit after this rally started, we have just absolutely exploded back to the upside. And that's what happens when you continually finish at or near the highs of the day. And we've been doing that a lot on our major indices. S&P 500 up almost 1% yesterday, another 54 points. We're back above 5,600. That's the last 100 benchmark until we hit an all-time high. If we hit the next 100 mark, that would be 5,700. That would be an all-time high. So again, S&P 500, which took a big hit, dropping probably 10% or more, has gotten almost all of it back, maybe all but 1.5%. So big move back, 1% yesterday. Again, look at that AD line. It is going straight up. That's not generally what you're going to see in a bear market. You're probably going to see flat. You might see a little bit of down. Then when we rally, you might see it go up a little bit. But that is, that AD line was looking really ominous about 2 weeks ago, 3 weeks ago. And now we've had such a huge rally. It's hard to be anything but impressed by the rally that we've seen. NASDAQ 100 yesterday gained 1.3%. And this is where I'm seeing maybe just a little bit of, when I was talking about the rotation and how the rotation might be a little bit away from some of these aggressive areas like technology. I mean, listen, technology's had a huge week. Don't get me wrong. The last 5-6 days have been powerful to the upside in technology. And they've led all sectors. That group has led all the other sectors by a considerable margin. But if you look at where we are on the S&P relative to its all-time high and where the NASDAQ is relative to its all-time high, I think you start to get the impression that it's not just technology this time. We're seeing a lot of financials going right back to all-time highs. We're seeing industrials doing the same thing. Some of these more, I still consider those groups aggressive groups because they tend to do better than the defensive groups for sure. And they also can outperform the S&P 500 for periods of time when the economy is strong or when it's expected to strengthen. So I'm seeing a little bit more rotation into some of those other areas like industrials and financials, which I think is bullish for the secular bull market run to continue. We don't have a lot of periods where those two groups lead to the upside, but we do have periods of time that can go on for a few months to even a year or a little bit longer when we see financials and industrials kind of take the baton and show some leadership. And we see a little bit of relative, I'm not going to say weakness, but maybe just stagnant on a relative basis from areas like technology. So anyway, NDX up 1.3%, another good day, climbing above. And what's been impressive about this rally, by the way, is it's been straight up, and there have been multiple levels of resistance, and it's like they're not even there. When you look at the S&P 500, there were probably 3 or 4 different gap resistance levels and both moving averages and price support. When you go down and you establish a low and then you bounce back up and you've tested that support level 3 times and then you lose it, that becomes a key resistance area. That's price resistance. So you throw all of this stuff in there, there's probably 6 really significant resistance levels on the S&P, and we didn't even pause. It was just one day after another, just taking out one level after another. Very, very impressive rally. So if you want to know why I'm not bearish, it's because I'm watching and I'm observing what's taking place in the market. And there are a couple other reasons, which I'll talk about a little bit later in the show. Mid caps also rallying back, got back up over the 3,000 level here in the last couple of days. Still need to move back up above 3,100 though to challenge the all-time high. So we got a little bit of work to do, but mid caps also bouncing nicely in all of these AD lines, except I would say Russell 2000 seems to be, again, maybe a little bit weaker on that rally on the AD line. I mean, we were really strong back in mid-July, and then we rolled over and went down to basically the April low, which was the 6-month low in the AD line during that drop, because we did have a couple of big volume drop, down days where we finished at or near the lows. You can see the volume at the beginning of August with these drops finishing closer to lows or even on the lows than what we saw in the S&P and the NASDAQ. So as a result, we took pretty big drop in the AD line on this rally, we're definitely coming back. It's just not as strong. Probably again, I think, because of the history of the last 2 or 3 years, I think, traders are probably still a little skeptical of the small caps. I think we're going to see what the small caps are made of when the Fed finally says, hey, we're lowering. I think that's going to be a test for the IWM. I believe it'll pass it. I think it's going to come back strongly, but we'll wait and see. Transports rebounding pretty nicely as well. This is another one where the AD line not exactly flying to the upside like we're seeing on some of the major indices. So maybe there's a little bit more hesitation there, but still rally from 14,800 to about 15,800 in less than, probably in a half a month. That's a pretty strong rally, 1,000 points on the transportation index. So everything is participating back on this move to the upside, although some are maybe showing a little bit weaker signs than others. All right, moving on to the sectors. So technology, clearly, this past week has been unbelievable in terms of the areas of resistance. You have to realize that when we started falling, we lost a couple of different necklines on the XLK. Here was a downsloping neckline. I talked about this back in July and said if we broke below 220, that would measure down to about 204, 205. After we broke down, what was it? Maybe 8-9 trading days later, we were down at that. We hit that 205 level. Ended up going down one more day, and then back up we rode. Now, this other head and shoulder, this neckline came in right at about 208 to 210, depending on how you draw your line. But that would have measured down to about 180. We didn't get that far. We got down to 190 and then turned right back around. We held the April low from just 3-4 months ago and then rebounded off of that. But this rally has come back up. It's gone through gap resistance levels. It's gone through price resistance levels. It's now gone through both the 20-day and the 50-day and all the necklines. I mean, and this has taken place in 2 weeks. So you have to be impressed by this rally and look at the AD line on the XLK. It is absolutely screaming back to the upside, nearing a breakout even before we get up, close to that break. Well, we're getting closer, but we still got a little bit of work to do to get up to that breakout on the absolute price action on the XLK. Yet you got the AD line already, threatening the breakout. XLY up 1.25%, pretty much the same thing, going through a lot of different resistance levels, not acting nearly as bullish as the XLK, but not badly. AD line soaring back to the upside, not far from breaking out again. Communication services. This one, from a price perspective, might even be the closest in terms of breaking out among the three that we just talked about. But AD line here is a little bit weaker. So, I mean, everything's got mixed signals, a little bit of mixed signals as far as what's the strongest area or where should we be, maybe thinking about investing or where should we be parked and for how long. I mean, all those things seem like they're changing by the week. But certainly communication services making a move back up near its all-time high. It's hard to view that as anything but bullish. Semiconductors. Now, this is the one that back in June, this top, that was a bearish engulfing candle on very heavy volume. And I said, until we get a breakout above that 21,000 level on semiconductors, you've got to consider that to be the top. Well, here we are 2 months later, and that's still the top, 21,000. But this rally has been strong in semiconductors. And look at the AD line breaking out to a new high. This just doesn't give me the feel of an extended bear market. I mean, yeah, we had some tests for the first week when we were bouncing, but we're now passing every one of those tests. So what I've been saying is that I don't believe we're in a downtrend. I now believe we're in sideways consolidation. That's what happens when you go below moving averages and go back up above moving averages. When you are in a downtrend, like we were during the cyclical bear market of 2022, you don't do this. You don't go, roaring back up above, key moving averages and do it with AD lines screaming to the upside. You don't do it with the volatility index moving back down below 17 for the fourth consecutive day yesterday. 4 days in a row now. And we're not just at 1675, we're down in the 14s. There's never been a bear market that I've tracked since we've had access to the VIX where the VIX has gone back down below 17. Now, I've had somebody write in before and say, well, no, no, no. 2000 to 2002, we had a bear market. 2007 to 2009, that was all part of one big secular bear market. And the in between of those two bear markets, 2003 to 2007, the VIX went below 17. That's not what I'm talking about. I'm talking about during the decline. So 2000 to 2003, 2007 to 2009, we didn't go below 17. We did not close below 17 on the VIX during those entire bear markets. We're talking a couple years each. Look back to the cyclical bear market of 2022. VIX didn't go below 17. Look back to the trade war. Of course, that was a pretty quick cyclical bear market. We didn't really have too many. We had a couple rallies, but when we did rally, the VIX didn't go below 17. The pandemic, of course, was really quick. That was just 4 weeks, pretty much straight down. But again, VIX stayed above 17 the whole time. So if all of a sudden this turns back down and we do morph into a bear market, this will be the first time in this century, at least, that we've seen the fear come out of the market as much as it has, and then still go back down to a new low. Because bear markets require a certain level of fear. You need that fear to be inherent in the market to keep the downtrend in place. Folks, this downtrend, we were stuck trying to get through the 20-day moving average a couple of times, but we're not stuck right now. We went through the 20, we went through the 50, both of them like a hot knife through butter. Again, you've got to adjust to what you're seeing on the charts. I could sit here and just beat, my fist into the table and say, oh no, it's a bear market. I called it 2 weeks ago, so I'm going to stick with it. Well, that's not really going to do you any good if we turn around and move back up. Maybe we go sideways for a little bit, but I ultimately believe we're going to break out to an all-time high. And I think it's, based on the fact that now it looks like it's going to be more sideways consolidation. I think the all-time high comes in the fourth quarter. When we were going through what I thought might be a little, a strong correction, possibly a cyclical bear. I hadn't quite decided on that yet, but I thought we were going to have a strong correction. I did not think that August low was going to be the low. I think, based on what I've seen since, I think that low is in. Could we go back down and test it? Yeah, that's what sideways consolidation means. Recent highs, recent lows is what you kind of look for as your range. So I could see, the election getting nasty and folks, the market getting very uncertain because of that. Heck, we could have a initial jobless claims number that's higher than expected on Thursday, and all of a sudden everybody gets defensive again. I just don't think we're going to go back down below that August low. That's all. Automobiles also having a strong day yesterday, gaining almost 3%, 2.8%, back up above moving averages. Tesla, of course, had a pretty good day. AD line starting to rally pretty strongly relative to how much of the price action that we've recovered. And then finally, another really strong group. This was in communication services, but broadcasting and entertainment. We haven't talked about this group in a long time because even while the market was going up, setting new highs, this was one of the worst relative areas of the market to be involved in. Just absolutely been going nowhere. Earlier in August, we set a 52-week low. And now we're rallying back. We're back through the moving averages. But I want you to look at what sideways consolidation looks like, because this is kind of a perfect illustration. Above the 20, back below the 20, above the 20 and the 50, back below, back above, back below, and now we're back above. We haven't made any kind of breakout that would convince me that this downtrend or this sideways consolidation is over. We need to get through about 1125 on this index. If we do, then I'll feel a lot better about things there. All right, S&P 500. I mean, look at the last 5 days. I'm going to zero in here. Look at these 5 candles. Does that look anything like distribution? Because what I like to see and what we saw during the 2022 cyclical bear market is when the market is going down, every period during the day is weak. You gap down, you might see intraday moves to the upside, but then you come down again in the afternoon, you finish lower. There were a lot of issues with not finishing the end of the day. Look at these last 5 days. I mean, could you finish much stronger? Honestly, it looks like 3 of the 5 days we finished exactly on the highs, and the other 2 days probably within 5% of the day's range toward the top, like 95% of toward the high. I mean, these are really strong candles. This does not look like distribution at all. This is not what that looks like. So for me to sit here and say, "Oh yeah, we're going right back down, or we're going to go to a new low," you're not going to hear it from me. I'm going to call what I see. I thought we had some issues, especially with some of the economic reports. Think about what we've seen in the last couple of weeks. We've had two really good initial jobless claims reports. We had an unbelievable report on retail sales, way above expectations, not consistent with some of the signals I was seeing previously that said our economy was rolling over. So at this point, right now, the Fed honestly looking a little bit like a genius, and I've given them a lot of grief, and I still think they should be lowering rates because they raised rates because of inflation. If you don't think inflation is a problem, they should be bringing it back down rather than risking the health of the economy. That's what I believe they should be doing. So I still disagree with them. But the fact that the economy did show signs of resiliency again over the last couple of weeks, I think that's just giving the Fed a little bit of a leash in terms of what they do. Now, that could be a good thing or a bad thing because first they got the Jackson Hole meeting coming up later this week, and Fed Chief Powell will be speaking on Friday. Those of you who've been with us a while know exactly what happened in 2022 when the Fed chief was speaking from Jackson Hole. That was his famous "more pain ahead," and that's exactly what we got for the next 2 months after he made those comments. So I don't know what he's going to say later this week, but I do know that we've got another Fed meeting coming up in September, middle part of September. So it's probably about 4 weeks away. What is the Fed going to do? I don't know. I think if we get inflation reports that are still good, they're not great, but they're definitely not bad. I think it gives them time to maybe wait another month if they want. I mean, they've done it before when we thought they were going to lower rates. That's kind of been their, if they're consistent about one thing, it's fearing inflation. And so, if economic reports come in and give them the leash to leave rates where they are for another month, they may just do that. And I don't think the market would like that any more than they liked it last month. So anyway, we got that to look forward to. We got like I said, presidential election cycle. There's a lot of things that still could go wrong to, at least trigger some back and forth. And that's what I'm expecting. I would be, even after what I've seen over the last 2 weeks, I would still be shocked if the market just goes right up and sets new all-time highs. Time of the year, as weak as we were 2 weeks ago, to then be that strong just a couple weeks later, still not really knowing what the Fed's going to do or how the election's going to play out, yeah, I'd be a little surprised. I don't rule it out. I don't rule anything out to the upside in a secular bull market, but it wouldn't be where I would place my highest odds. I don't think we're going to break out. I think we might go up, test that high. Maybe we have a little bit of a false breakout, but then I would expect that we're going to pull back again, probably in the latter part of August and especially during September, which historically is not a good month. So we got to factor in all these different things. Trust me, it's not easy. I always say, from a long-term perspective, I can feel pretty comfortable about making longer-term calls. Short-term, I'll get signals once in a while. I think for the most part, they're pretty good. But we've seen again how quickly this market can just change on a dime. So trying to make 1 day, 1 week, 2 week predictions on what the stock market's going to do, I think it's just shown everybody how unpredictable it can be. All right. So there is the semiconductor group. So you can see there's that move up last 5 days. Actually, most of the last 8 days, we've been closing right on the high. If you go back to the bottom, the only bearish day we saw was that Wednesday after that big Monday gap down where we had gapped up and sold off all day. Big red filled candle. But that's the only one in this entire uptrend that I would say looked bearish. Everything else here either looks neutral or bullish, mostly bullish. And again, that AD line breaking out, that would really be unusual to see us go back down to new lows after we see another breakout in the AD line. Doubt that we're going to see that. One thing I think is helping semiconductors right now is we've got NVIDIA's report, coming up on the 28th. NVIDIA has a history, long history. I've talked about NVIDIA's best months of the years being February, May, August, and November, because NVIDIA has a history of running up into earnings. And if we look at NVIDIA, you'll see that this month, after the gap down on that Monday, I mean, we've come rallying back, and we're basically doing what NVIDIA does during its earnings months. It's going higher. Again, would I have expected this, on August 5th? No, I would not have. But again, market does what it wants to do, and we have to react and adjust to it. All right, S&P 500. Now, I'm showing you a long-term chart here, 10-year chart. I'm showing you the AD line. Here's price action. Here's the AD line. So when we went through the bear market back in 2018, the cyclical bear market, the trade war, you can see the AD line. We topped before that bear market started and kind of went sideways, a little bit down. Here in 2020, of course, the pandemic, we went straight down. But remember, a lot of that was gap downs. I mean, I wrote about it. I talked about how it was likely to turn out as a healthcare issue, not a financial issue. And it was a lot of the gap downs and recoveries that was telling me that we were being manipulated to the downside. And look at the AD line. I mean, the AD line during that month actually went up to an all-time high. That's not distribution. That's accumulation. And right back up we went. During the cyclical bear market, when it started, we were actually first 2 or 3 months kind of going sideways. We were not setting new highs, but we really weren't backing off very much either. But once we got later into the bear market, and remember back in June of 2022 is when I said the bottom was in, one of the reasons was the AD line was breaking out to an all-time high. That made me start looking back intraday at the QQQ and the spider to see what was going on. And what I found out was going on is starting in May, we stopped selling off in the afternoons. We started seeing accumulation in the afternoons, which was different than what we saw in the first 2 or 3 months of the year. So that was an early clue that that cyclical bear market was going to be just that, cyclical. It was not going to be secular. The Wall Street was pouring in. Starting in May and June, we started seeing accumulation. And, most of Wall Street's not buying and selling every other week. They're accumulating for the long term. And then right in here is when the Jackson Hole speech came out at the end of August 2022, and we had that final drop and put in a slightly lower low into October and then made this push back to the upside. I mean, could Powell do something similar? Sure. He could come out and say, we're still not comfortable with inflation where it is. And we still think inflation's the bigger problem. I mean, I don't think the market's going to take that as good news and break out to a new high if he says something along those lines, which I still think is very possible. So I don't know. I don't know what Powell's going to say. I actually think he kind of likes market weakness a little bit. I think it takes some of the inflationary pressures, out of our system. So I don't think he's really worried about the stock market. And to be honest, that's not really his job. But if he does his job well, it should benefit the stock market. If you manage price stability and unemployment well, the stock market should benefit from that. It's the whole idea behind the Fed to begin with. So it's not that the Fed's there to help the stock market. A lot of people talk about that. I've never thought that. I don't believe that the Fed's there to help the stock market. The Fed's there just to try and stabilize our economy, stabilize prices, and just try and keep us growing at a pace that's sustainable. And if we do, if they're successful, that'll help the S&P 500. That'll help stocks. All right, it's 9:30. I do want to talk about a couple of things, though. Number one, here is the sector summary from yesterday. You can see technology, consumer discretionary, communication services. Those are the three biggies. They are 1, 2, 3 yesterday. So another big solid day and another under the surface, day of strength. If we go back to last week, so I showed you all those bullish candles on the S&P, technology up over 5%. All 11 sectors, by the way, are up. So we're getting wide participation. Everything's on, trying to go higher, but technology is leading. Consumer discretionary right behind, 4.4%. Financials and industrials. This is what I was talking about. Financials and industrials did pull back on a relative basis for a little bit, but that was after a massive move to the upside back in July and early August. So I think money is going to rotate, and we're going to see financials and industrials from this point forward through the end of the year. I believe they're going to be the leaders. I mean, maybe I'm wrong. Maybe technology is just going to take off again, but I really believe it's going to be financials and industrials. And I think the fact that they're staying close to technology's got all kinds of reason to be bouncing because they got absolutely crushed in the earlier part of August and back in July. Second half of July into August was very, very rough. So last couple of weeks, they've had reason to bounce. They've led, but they're really not leading financials and industrials by that much. And I think that's really the key coming out of this is I think those two groups are going to be groups to watch for the last 4 months of the year. All right, here's the VIX going up into the 60s on that August 5th, that Monday morning drop where we saw the major indices drop about 5% on the open, 4.5%, whatever it was. But then we rallied back and we saw the VIX drop back down into the 30s. And 5-6 days later, we were back down below 20. And here's the last 4 days where you can see that the VIX has closed below 17. Right there. So I'm not saying that it's a guarantee we don't go lower. I can't guarantee anything. But if you follow signals in the market, you study history, then you would know that when you get a VIX that drops back down below 17, call off the bears. Doesn't mean we won't go down another 5 or 7% again. I'm not saying that. Again, I think the most likely courses over the next 2 months is going to be sideways, back and forth. Volatility up, then volatility back down, volatility up, back down. And I think price action goes back and forth. I think there's a chance we break out. I think there's a slim chance we go back down and take out that August low. But when I look at the market, I'm trying to evaluate the risk of things. I'm not trying to point out a guarantee. I'm not trying to tell you that we're guaranteed to go do this. I don't do that with my own investing. I look at the charts and I try to get a sense of where I think the most risk lies, and I try to avoid it. So if I think the market is toppy, like I did back on, around the Fed meeting or even before the Fed meeting with semiconductors and so forth, then I'm going to take necessary precautions. I mean, I went a long time without trading any of the semiconductors. I just didn't like the way the chart was setting up and how much we had gained. Now, I think, maybe we go back up and we get that double top. But again, I don't think we break out. That's just my feeling. Now, I got a message from a member, or a question from a member, and it's not the only time I've gotten this question, so I thought I would address it here. But the question was basically, he's looking at our portfolios, and, I'll tell you right now, I mean, our goal was to beat the S&P 500, and over the last couple of years, that's been challenging for the model portfolio, and it's been, we haven't come close to doing it on our aggressive portfolio. And keep in mind, aggressive portfolio is just that. We're looking mostly at small caps, mid caps. So there are reasons why. The model portfolio, though, I think has done honestly pretty exceptional, even though it's underperformed the S&P 500. And I'll explain why. First, I'm going to pull up a couple of other aggressive funds that I would say are generally similar to what we do in that they'll pick a lot of small mid cap stocks. And they're just very aggressive in that way. They're not funds that are just going to concentrate in the Mag 7. So the first one I'm going to show you here is the Innovator IBD 50 fund. And if you notice, 2020 into 2021, this Innovator 50 fund had a tremendous run. Cyclical bear market went all the way back down, gave away all those gains. And if you look in 2023 and 2024, it's mostly flat. Had some strength when the market was really moving from November to March. But other than that, I mean, we've basically been flat. And if you look back to the final quarter of 2018, November of 2018 is when we started our portfolios. The Innovator IBD 50, which I think is a good reflection on what a lot of aggressive growth funds have done, we were probably up close to 30, maybe 27, 28. And now here we are almost 6 years later at 26. It's gone nowhere. It's gone up, down, up, sideways, down, whatever. It hasn't really done much. And look at it relative to the S&P 500. So if your goal is to outperform the S&P 500, you'd say, well, FFTY is a miserable investment. I'd probably come to that conclusion as well. How about Kathy Wood and all the ARK funds? Here's ARKK. So ARKK is sitting in the mid 40s. And back in 2018, it was probably in November, somewhere around low to mid 40s when our model portfolio was launched. So again, here's one that's relatively flat since 2018. Now, if you're going to compare our model portfolio, while we always compare it to the S&P 500, because that's the benchmark, I feel like over time, we're going to have some S&P 500 companies. We're going to have some small caps. We're going to have some mid caps. But over time, the hope is that we'll have some of the best stocks, and that as indices go higher, that leadership will help propel us. Now, if you've been following the market, you probably know that the primary reason the S&P 500 has gone up as much as it has is because of the Mag 7, or many of the key stocks in the NASDAQ 100, the highest weighted stocks. And unfortunately, unless you have a portfolio that includes all of them in your portfolio, you've got an uphill battle to face. Now, I want to show you, I'm going to take these charts down, so bear with me a second. And I think I have to reshare my screen as well. So let me do that. All right, and now I will set it up again to share. This is a screenshot. So this is the model portfolio back in 2018 when we started and where we are today. Now, if you look at IBD, that Innovator 50, or you look at the ARK funds, they're still trading where they were in 2018. Our model portfolio is up 192%. So we've almost tripled since we started this portfolio, picking stocks similar to what IBD Innovator 50 would pick, similar to what Kathy Wood would pick. I mean, we've owned some of the same stocks over the years. But when we see a cyclical bear market coming on, like in 2022, we actually changed our portfolios and went more with defensive. We wanted to stay invested. This whole idea of our portfolios is you want to remain invested 100% of the time. So it's kind of buy and hold, but with one major exception. Every 90 days, we switch out stocks. So you're always 100% invested, but we're always trying to look for leaders. So I would say if you look back and you say, hey, if I invested in 2018 and I tripled my money by 2024, I don't think that's bad. I think we've done a pretty good job. But the S&P 500, if you look maybe since here, if you want to go back to 2021 and say, well, in 2021, the S&P has just continued to go up and the model portfolio hasn't. And I'd agree with you. It's underperformed for the last 2 or 3 years in total. I think we did outperform in 2022. I think the S&P was down 19%. I think we were down 14%. So we did beat by 5 percentage points, but we lagged in 2023. And we've gone up in 2024, but I think we're lagging in 2024 as well. Now let me show you why. So I'm going to go back and grab the other screen again. Let's pull this up. And I think I got to reshare. And then we're going to wrap up after this. All right. So now we're back to the ARK chart. Now I want to show you Because really the problem has been since 2021. I think we can agree. I mean, even on the model portfolio, haven't outperformed. And by the way, the aggressive's done much worse. I think I'm pretty proud of what we've done with the model over the years. Here is the IWM. Oops, I want to do it down here because I want to show you the IWM over the last 6 years. And so the IWM down, look at where the IWM was or is relative to where it was in 2021. It's still down from those peaks. The mid cap, finally, we broke a little bit above those peaks. But when you look at the S&P, SPY, you see from 2021 a lot more strength. And a lot of that was being driven by the Mag 7 stocks. So my point is, if you're investing in small and mid cap stocks and those areas are underperforming, I mean, we can go back to the IWM. I mean, look at the IWM over the last 3 years relative to the S&P 500. If you're pulling stocks out of the IWM and the IWM is getting absolutely crushed by the S&P 500, it kind of makes sense that unless you're really good at stock picking and you get the absolute best, you're probably going to hurt your performance with small cap stocks. If we pull up the mid cap, you're basically looking at the same thing. We did come up in 2023, but look at where we are right now relative to where we were 3 years ago. If you're putting these stocks into your portfolios, which we do, then you're getting clobbered. I mean, if you're putting stocks in areas other than technology, discretionary, and communication services, and especially the largest stocks within those areas, it's an uphill battle all the way to try and take stocks in other areas and outperform. Now, our portfolios are not diverse. I mean, if you're looking for diversity, diversification, that's really, our portfolios are not really where you want to go. So I always talk to members about, hey, if you're going to take that really, you got a portfolio of say $1 million and you're going to take 100 or 200,000 and say, all right, I want to be aggressive with this. That's where I would say our portfolios come in. It's not taking your entire portfolio and putting it in. I'm telling you right now, we're going to take risks in these portfolios that probably would not warrant you putting 100% of your money in. I mean, it's just, we're going to have periods like we did in 2020, 2021, where we absolutely explode. And then we're going to go through periods like we have over the last few years where most areas of the market are not keeping up with the S&P 500, and most funds are going to struggle because unless you have a fund and you're only lining it with Apple and Microsoft and Nvidia and AMD and Meta and Tesla and Netflix and Costco, I mean, if you don't have those as your primary ingredients in your portfolio, you're not going to outperform. So anyway, I just wanted to respond because that's what's driving our portfolios. And that's what's making it difficult. And like I said, I think our model, if I go back quarter by quarter, we didn't do so great in this last quarter. But again, some of the growth stocks that we were in got hit with the overall market in July. We did get a little bit of bounce back in August, which was nice, but not enough to make up the ground. But if you look back the last couple of years, I think the model has done okay. The aggressive has been much more challenging, but that aggressive is where we normally see a lot more small caps and mid cap stocks. So if I'm right about small caps and mid caps, and they do lead later this year into next year, I would fully expect that our aggressive portfolio would do better. And I think our model would do better. But anyway, that's what I want to talk about. Let's take a look at what the market's doing. We're now 15 minutes in, so it's a pretty long discussion here. But anyway, Dow and the small caps both just down slightly. S&P and NASDAQ both up slightly. VIX gaining a little bit, still below 15. Overall, I think the market looks pretty solid. Let's see what does. Here are the stocks down. Bank of America among the losers today. How about on the upside? Palo Alto Networks leading. Lilly having another really nice day, gaining more than 4% today. PayPal back up above $70. That one's been mired in nowheresville for a long, long time, but maybe it starts to pick up. And there's Netflix having a pretty strong day, moving back to that 700 level. Tesla again on the list of winners as well. Anyway, that's it. Hope today's session was a little bit helpful for everyone. kind of giving you a little bit better sense of where I see the market and why. I've made some changes in the way that, I look at the market now versus literally just 2 weeks ago. I think the biggest change is that rather than looking at maybe a downtrend and a correction, I'm looking more at sideways consolidation and, more up and down choppy action, probably through maybe sometime into October as we get closer and closer to the election. Anyway, everybody have a great afternoon, rest of your day. And I'll be back tomorrow for the live trading room at Earnings Beats. So if you're interested in that, make sure you go over to Earnings Beats and start your 30-day trial. Love to have you. Have a great day, everybody. Happy trading.